In our last video, we talked about the two kinds of investors on the market's roller coaster, the fearful and the confident. We established the goal isn't to change who you are, but create a plan so that you feel confident no matter what the market does. But how do you actually do that? How do you build that confidence? Today, we're going to dive into the single most important tool for any serious investor, your investment policy statement, or IPS. Think of it as the architectural blueprint for your entire financial life. Without this blueprint, you're building a financial plan without a foundation, with nothing more than the hopes it doesn't come crashing down in a period of volatility. We're going to talk about what an investment policy statement is, and more importantly, how to use one with your portfolio so you're always prepared. As a business owner, you would never launch a new product or a new division without a detailed business plan. You'd analyze your market, define your objectives, and set clear metrics for success. So why do so many successful professionals treat their personal wealth with less rigor than they do their business? The answer is often a lack of clear, disciplined processes. An investment policy statement provides that process. It is a formal document that outlines your investment philosophy, goals, risk tolerance, and asset allocation strategy. But it's more than just a document. It's a rulebook. It removes emotion from the equation, giving you a clear, objective guide to follow when the market tries to scare you. I've had the conversation time and time again with people casually looking to have investment discussions with me in social settings. Most of them, if not all, don't have an investment policy statement and have some degree of panic during a downturn, selling at a loss, having no roadmap for getting their investment strategy back on track. An investment policy statement is your support against making that very mistake. This isn't about predicting the future. It's about building a portfolio that can weather any future. I want to break down an effective investment policy statement into 3 core sections that allow you to truly stress test your financial plan. This is the most crucial part of the process. Your objectives are your personal financial goals. Are you planning for a tax-efficient business exit in 7 years, a comfortable retirement at age 65, or a legacy for your family? Your investment policy statement must clearly define your time horizon. When will you need this money? A 20-year horizon for retirement is a very different plan from a 5-year horizon for a business sale. Your risk capacity. Not only your risk tolerance, but your actual capacity. This is an objective measure to how much risk your finances can, and in some cases have to, absorb for you to be able to achieve your life goals. A 30-year-old entrepreneur with a booming business has a different risk capacity than a 55-year-old with most of their net worth tied up in their company. Your investment policy statement should clearly define what that looks like specifically for you and your situation alone. Once your objectives are clear, you define how you will achieve them. This selection details your investment strategy, including your asset allocation, which is the specific mix of assets you'll own, the percentages allocated to domestic and international equity, government and corporate fixed income, or any other alternative asset classes that might align with your situation. This is where you build those safety features I alluded to in our last video. What kind of investments are you willing to own? Are there any sectors or industries you want to avoid for personal or ESG-related reasons? Are there any asset classes that you feel will overweight your exposure based on your current job or business? A blueprint is useless if you don't follow it. Set specific rules, such as rebalancing my portfolio annually, or if any asset class drifts by more than 5% from its target allocation. This simple rule forces you to sell what's overperforming and buy what's underperforming, creating an automated buy low, sell high strategy. Without this rule, most people do the exact opposite. They chase returns by buying what's hot and selling what's down, locking in losses and missing out on the recovery. You should define what success looks like for your portfolio and your portfolio alone. Instead of comparing yourself to a headline like the S&P 500 is up 20%, your investment policy statement will compare your balanced portfolio's performance to an appropriate blended benchmark. This prevents the feeling of falling behind and keeps you focused on your goals. The power of an investment policy statement isn't in its complexity, it's in the clarity it provides. It transforms your relationship with risk from an emotional reaction to a disciplined, logical approach. It's the ultimate stress test for your portfolio. When the market storm hits, you won't need to wonder what to do. You'll just follow the blueprint you created well in advance. To help you get started with this crucial first step, I've created a free, downloadable sample investment policy statement that I use with my own clients. It includes all the sections we just discussed to help you create your own blueprint. You can view the template by clicking the link in the description below. And remember to subscribe so you don't miss out on our next video, where we'll dive into the specific investment vehicles that belong in a well-diversified portfolio.